In this video, we continue discussing our understanding of insurance and insurance planning and management, and what are the key terms associated with the insurance segment. In this video, we're going to look at the need of how do we calculate the insurance premium broadly, understand the introduction to that, and understand some of the key terms associated with the insurance industry. Right. So in how to determine what kind of insurance we are going to kind of try and need. There are broadly three kinds of insurances that any individual should possibly look at as a protection. The first one would be to replace the income in case something were to happen to the person, right? So that's where your life insurance comes in, where if there is permanent damage to income because of some untoward incident that has happened, the family has assurance of the income that comes in. So that's life insurance basically. When you want to protect your income, in the sense that you want to protect yourself against large losses, when you expect a large outflow, you will probably have what is called as health insurance or medical insurance. Again, a necessity in today's day and age because medicine or medical charges have increased dramatically. So to protect your income from depleting just in case there is a medical emergency, you would need health insurance. And then you might have certain assets with you. You want to protect that from any kind of adversities. So you want home insurance. There's also fire insurance. There's theft insurance, right? So you can get insurance to all these, where if let's say you have a business which has a big showroom, you would want to kind of insure that showroom. You put all your life savings into buying a home, you would want to have a home insurance. Property insurance, which is a superset of home insurance, is essentially trying to protect the asset that you have and safeguard you from any kind of untoward incident or unfortunate incident that might result in the depletion of value of that asset, right? So that's where what kind of insurance you have to go and take. Usually, for every individual, life, health, and home insurance or property insurance are a must. Property insurance is a must if you own a home. Health insurance and life insurance are necessary in any kind of circumstances, right? Now, there are some basic terminologies associated with life insurance. We're going to talk about that. We're going to first focus our attention towards primarily life insurance, discuss the key parameters in life insurance, look at a sample policy statement, and then look at the kinds of life insurances that are available in subsequent sections. Then we will focus our attention to other kind of insurance products. So the person whose life is being insured is called the insured, right? It's the person who's going to pay the premium and get his or her life insured. The term of the insurance is the period during which the insurance cover will be available to the insured. Usually something like 20 years or maybe 15 years, in some cases larger than that. Usually you will find that's 10 to 30 years is the standard term that people look at. Some people also take policies which last whole life, right? So there are different terms that are available, but basically the period during which the insurance cover will be available is called the term, and in your policy document this is clearly mentioned, right? Then the premium. Now what is a premium? Remember the law of large numbers. Everyone pays a small amount to the insurance company, and so what the payment that you do to the insurance company is called as the premium. This will depend upon the sum assured and the term. Correct? Now let's think about it. Uh, if you want to cover the insurance to a larger level, so we will not calculate the exact premium at this point of time, but let's say the insurance cover is 20 lakhs and 10 years, and you get a premium X. If the insurance cover becomes 40 lakhs and 15 years, your premium will have to increase. Correct? Your premium will now become Y, and Y will be greater than X. surely, because you're insuring yourself for a bigger amount and you're insuring yourself for a longer period, right? Remember, you're transferring the risk. Because you're transferring the risk, someone else is taking the risk. To take that risk, they will expect a bigger amount that you will pay. So the premium basically depends on how much risk cover do you want to take, which is the sum assured, what kind of money you're going to get back in case something goes wrong, and the time for which you are wanting the risk to get covered. Sum assured here is the amount that is being insured. This will be the payment in case the event occurs, right? So the payment in case the event occurs is going to be the sum assured. This will be multiple times your premium paid, because that's the idea of insurance. You pay a small amount and then you get a lot of you get a bigger money or a lot of money in case the unfortunate event occurs, or your family gets that money in case the unfortunate event occurs, right? So that's the idea of sum assured. There are some other key characteristics that you will keep hearing when you look at a life insurance, right? So you hear a term called bonus. Bonus is an amount that is added to the sum assured. It can be part of the cost reduction that happens, during the course of the policy. Now, usually life insurance policies could be of two kinds broadly, right? Some which gives only risk cover and some which give risk cover plus investment characteristics. When you look at the investment characteristics, you basically pay money. You pay the money which is paid in the form of these premiums. Once these premiums go to the insurance company, they invest the premiums. So premiums, in the case of investment kind of policies, get invested and then you get returns. So there is some part which is like broadly a fixed kind of a return. And then if the company makes more money, you can get a bonus as well, which is in case the company's costs were actually lower than what they had anticipated, they will pass on some of the benefits to you. There is also something called as a guaranteed bonus in some policies, where given if a minimum number of years have passed, remember, let's say this is a 20-year policy and 10 years have passed, they might say after 10 years, if you still are there as a policy holder with us, we will give you a guaranteed bonus amount. This could be a small amount. This may not be a very big amount, but there is a guaranteed component in terms of returns that people might get if they stay that long in a policy, right? Then there is something called as reversionary bonus. This is based on the performance of the insurance company and declared essentially for policyholders at the discretion of the insurer, right? At the discretion of the insurer. Now, what do we mean by performance of the insurance company? You take premiums and then you invest, and this will result in some sort of a performance. If the performance is far better than what you had expected, some part of that you might have said will be a guaranteed bonus. If you stay for a certain period, I will give a certain return. Some part of that could be, broad bonus that's going to come. Reversionary bonus is bonus if you're going to pay only if you want to. At the end of it, you made money, and the insurance company may or may not want to distribute those earnings with the policyholders. Reversionary bonus is the part of the bonus which is considered as the discretionary payment that the insurer will do, right? Payment to the beneficiary, usually sum assured, or the portfolio value. In case nothing untoward happens to the individual, after the term, you will get the portfolio value, whatever is the portfolio value, in case you're looking at an investment product. If you're looking at pure risk cover, then it is similar to the vehicle insurance that we do. You just keep paying the premiums. You don't really get any return that comes to you, right? There's another term called participatory policies. Now, participatory policies are policies where holders can benefit from the profits of the insurance firm. Typically, here is where you will get your bonuses as well. So, essentially, in participatory policies, what happens is when you make profits, right? Profits could come either because of investment returns or because of less risk materializing, right? How does this work? Less risk materializing. The company takes a certain amount X from 10,000 people, expecting that 5 people will need. That's an expectation. There is some sort of a probability calculation that is there saying that 10,000 people will pay and only 5 people will need the insurance. Now, at the end of the term, 5 people did not need the insurance, only 2 persons needed it. In real life, this number could be different. So, only 2 persons needed to avail the insurance policy or the amount, in which case you actually collected a lot of money which is lying idle. That can be given to the participatory insured people. In case you're making more profits, you could basically choose to distribute some of those. Such policies are called participatory policies. There are some policies which are non-participatory policies, where if there is profit, that's kept by the life insurance guy, the company who's insuring the person. Right? So those are some of the key terms that you will keep reading again and again. There is also some interesting terminology called lapsed and paid up policies. Right? Now, insurance usually is a long-term instrument, let's say 20 years or 25 years. If you stop paying the premium, if you stop paying the premium, the policy lapses, which means claim is not entertained. If you are having a policy of 20 years and the terms of the policy says you have to pay for 20 years or pay for 10 years, if you do not pay during that period or you stop paying during that period, once you stop paying, you are out of the insurance cover. That's called a lapsed policy, right? Now, in certain cases, you may not want to pay it. In certain cases, you may not have the money to pay it. In which case, there is one option that is available that can happen, which is you can convert a lapsed policy to a paid up policy. How can you do that? You can reduce the sum assured to make the policy paid up. What do we mean by paid up policy? A paid up policy is one where all premiums are paid. You've already paid those premiums, and that's why it is called a paid up policy. Let's take an example. Mr. X had taken a 25-year life insurance policy with a sum insured of 1 crore to be paid in yearly mode, premium to be paid. Right now, after paying the premium for 10 years, he's not able to continue paying the premiums. So 25 years, yearly premium payment. If I draw a timeline of 0 to 25 years, after 10 years, he stopped paying the premium. So effectively, his insurance was only for these 10 years. If he stops making the payment from the 10th to the 25th year, there is no cover. Correct? Now, that's a lapsed policy if you stop paying after 10 years. So what do? You've paid the premium for 10 years. For 25 years, the sum assured was 1 crore. Right? So for 25 years, the sum assured was 1 crore. You could say I have paid for 40% of the time during this. So why don't we reduce the sum assured to 40 lakhs? So if something were to happen to me during this period, 10 to 25 years, the sum assured falls to 40 lakhs, and that falls to 40 lakhs because you've already paid 40% of your requisite premiums. You will have to agree to reduce the risk cover, the insurance cover, from 1 crore to 40 lakhs. If you do that, the policy will be considered paid up because you've paid premiums for 40% of the time. So you can avail a 40% cover. If you don't reduce the sum insured, then in that case, the policy will be considered a lapsed policy. You will not get 1 CR in case any unfortunate event occurs to Mr. X in this time of 11th to the 25th year. But if Mr. X agrees to convert this to a paid up policy, then in that case, the reduced sum assured would apply And if something were to happen, 40 lakhs would be paid to the family. Correct? That's the example of a lapsed and paid up policy. Let's take a sample snapshot of a policy. How does a policy look like? And this is just one sample snapshot. There could be other kinds of policies that exist here, right? So typically a policy would say what is the minimum age and what is the maximum age. So minimum 18 years old, someone can take it, maximum 60 years old, maximum 50 years old can take it, and you have to have a minimum term of 10 years. So minimum term is 10 years. So if you're 50, you cannot have a policy of more than 10 years, right? Which is 60. You will note that it makes more sense for younger people to take insurance. We've already said that the need of insurance is more at a lower number. Monthly income, minimum 25,000 per month. They want this to be the income. And then there are, some sort of benefits that are there. Each policy may not have these. Some policies have this. We've just taken an example where a policy has annual increase in monthly income benefit, right? Now we'll see what that means. 3%, 5%, 10%, and based on that, your premiums will have to be paid. Your premiums and frequency. The minimum premium you have to pay yearly is 4,500 and minimum monthly is 500 rupees. Maximum, there is no limit. You can pay as per need and salary that you have. I can't go and take a policy for 50 crore if I want to, because they will look at what kind of salary I have, and essentially it's based on what kind of premiums can be paid by me, right? Then there are four kinds of options that this policy gives. Each policy can have different options. The first is a life option, which is lump sum payout on death benefit, right? So of death benefit. So whatever is the sum assured will be paid out in case there's loss of life. Then there is another option called extra life option, which gives you accidental death benefit. Lump sum payout of death benefit. In addition, extra sum assured in case of death due to accident. Why is that? If there is loss of life, which is known, then the family can prepare itself for that. In case of an accident, it is typically unprepared. Because there is unpreparedness by the family, you will probably need more money. And in this case, some policies allow you an extra sum assured in case there is an accidental death, right? You just didn't know that it is coming. In some cases, it might come because of health conditions or because of illness that happens to people, correct? Then there is an income option where some part of the sum assured is payable on death and the remaining payable as monthly income for 15 years, sort of pension, in case you want that to happen, that instead of getting a lump sum payout, you want to take some part of it as, let's say the lump sum payout was 50 lakhs. Now you're saying instead of 50 lakhs, I will take in option 3, 20 lakhs as lump sum payout plus an annuity being paid monthly, correct, for the next 15 years. So you could choose that as well. Then income plus option, sum assured paid on death, monthly income paid for 10 years. Monthly income can be chosen as level or increasing at 10%. That's the benefit options coming into play, correct? So that's basically the options that this policy has. Look at some of the other terms that are there. Now, death benefit is, for a single premium policy. Premium can be paid for the policy term. Let's say you pay 10,000 rupees each year for 15 years, correct? That's about 1,50,000 bucks you've paid, correct? Or you could pay for single term or in one shot. You can just pay one single premium, right? And that one single premium could be for 1.5 lakhs straight away, correct? In case you make a single premium, sometimes people say, I don't remember paying it every year, so I'll just pay in one shot. So that's a single premium. You get the higher death benefit is higher of 125% of single premium or sum assured. So if you have paid 2 lakhs, it's this into 125% or sum assured, whatever is the higher amount, you will get paid that amount, right? Obviously, your premium will depend on the sum assured. So these two numbers are not going to be materially very different. In a regular premium policy where you're paying it annually, you have, if let's say you have a premium payment of 10,000 multiplied by 10 times the annualized premium, all premiums paid till date into 105% or sum assured. Whichever is higher in these three, you will get that payout, right? Then we have said life option, extra life option. In income option, 10% of the death benefit is paid as lump sum. Remaining 90% shall be paid as monthly income over the next 15 years. 0.5% of death benefit every year for 15 years, every month for 15 years. So 0.5 for a year will give you 6%. 6% into 15 will give you 90%. That's what is being paid. Income plus option, 100% of death benefit specified shall be paid as lump sum. In addition, right? So 100% of death benefit is paid. And then a monthly income equal to 0.5% shall be payable for a period of 10 years. Obviously, in this case, the company is paying more, so they will be charging more as well. It's not like they're going to give the money out of their pockets. They're going to charge more to everyone who gets into this kind of an option, and pay it to everyone from the money they have collected from the insured people, right? And monthly income can be at a level of increasing at 10% as chosen by the policy holder. So that's our discussion broadly in this particular section. Now we have a couple of questions that we can answer. Explain how can you make a lapsed policy a paid up using an example, and explain the term reversionary bonus. Thank you.